Yeah. Someone says that you have money, you could have waited for them to win. No, you promise them first so that they work hard. Actually, if we win the trophy, they will be given 600 million Kenya shillings. That is 600 million Kenya shillings is about how much in Rwandan francs? I think 600 million is about how much? 6 billion is about 7.2 billion Rwandan francs. I think it is about 7.2 billion Rwandan francs. You can imagine that is what will be paid to the footballers. They are very well motivated. If they lose, it is them. Anyway, let's go for this. If you can see my screen, there is something that I decided not to cover because I wanted us to understand all the others. Then I will do the futures contract hedge. As we said earlier, futures contract hedge and forward contract hedge are similar in almost all perspectives. The argument, everything, but the futures are traded in a formal market. It's called the futures trading market. Like we have the stock exchange. So there is a futures market. In addition to that, futures are standardized. They are given in units. Like you can have 1 million futures in unit of 1 million USD. The other thing is that futures are quoted in America, so they are mostly quoted in US dollar. They are regulated by Futures Regulatory Commission. When paying the future, there is a deposit in the futures market to mitigate the risk. So the major difference is because futures are standardized, they are given in units. You buy futures in block. And if you can see my screen, we say that a future contract hedge is a strategy used to lock in an exchange rate today for a currency transaction that will occur in the future. The concept is the same as the forward contract hedge. Key features of currency futures contract: standardization, contract traded on the exchange. They are traded on the exchange. Have fixed contract, that is, they have a fixed size. Have fixed expiry month. Actually, for the futures, they have a fixed expiry period. They are settled daily through the margin system. The margin system, we say that the traders pay a margin to them in the market. I want us to have a small illustration so that I can demonstrate the futures. Illustration. A trader in Rwanda, in the name of Rwanda Coffee Export Limited, exports high-grade coffee to Europe. In the recent transaction, the transaction was an export that a shipment of USD 500,000 payable in 3 months. The question is, the concern in this trade is that the USD might depreciate against the Rwandan francs, reducing profit when converted. The current spot rate is 1 USD to 1250 Rwandan francs. 3 months futures rate is 1 USD to 1230 Rwandan francs. The future contract size is 50,000. When we say that the contract size is 50,000, it means that you can only buy the futures in units, in batches of 50. That is what it means. You can only buy them in 50. Meaning, because this contract is 500,000 USD, you can, to determine the number of futures to buy, you take 500,000, you divide by 50,000. It will tell you that you will buy 10 futures. The question is, examine the futures hedge. Let us look at this. Step number 1, determine how many futures contracts to sell. You will have the exposure, the amount under exposure in USD, or the transaction size is 500,000. The contract are only in batches of 50,000. So we say that the number of contracts is 500,000 divided by 50. You can buy 10 futures contracts. Now, at the end, you will receive the payment in dollars. Rwanda Coffee Export Limited should sell the 10 future contracts at the 3 months future rate of the Rwandan francs 1230 per USD. Look at this. When you buy the future, you are guaranteed of the exchange rate. So irrespective of what the exchange rate will be on maturity, you will be guaranteed this amount, 3 months future rate, similar to what we called in forward 3 months forward contract. So they will pay, they will sell at 1230. Now, how much amount will be realized? Step number 2, simulate exchange rate outcome after 3 months. We are told that USD depreciation. Now, we have the amount that is given. If you look at the question here, we are told that, let me look at this. We are told that the current spot rate is 1250. Then we are told that the 3 months future is 1230. There's something that I did not give. The 3 months, let me give it this way. 3 months period. Okay. Let me not put that question there so that you can understand. Evaluate the futures hedge if the market exchange rate in 3 months time is Rwandan francs 1200. So we come here and say, if at the end of the 3 months, if there was no hedging, if the trader did not hedge, how much will this trader realize? So we are saying that USD depreciate to 3 months. We say that this is the market exchange rate at end of 3 months. At the end of the 3rd month, the exchange rate in the market happened to be 1200. Now, if the trader did not hedge, how much would this trader have realized? The trader would have realized an amount equivalent to 500,000 USD multiplied by the 1200, the market exchange rate. This trader would have realized this much, would have realized the amount equivalent to 600 million Rwandan francs. Now, with futures hedge, I put it as with futures hedge, this trader will buy more by 1230. Remember, in our hedging, the contract was that the exchange rate would be 3 months futures rate is 1230. This means that there is a gain. This trader will receive more, 1230 minus the 1200, which is the market rate, multiplied by 500,000. There is a gain of 15 million. If there is a gain of 15 million, you will take what would have been realized, you add the 15 million gain, you get 1650. Let me give it another approach. We say that the amount realizable with futures contract hedge, the amount realizable with the futures contract hedge is equal to the amount of USD 500,000 we multiply by the Rwandan francs. How much? 1230 per USD. How much is this? Can someone give me 500,000 multiplied by 1230 per USD? Someone to give me this? Oh, okay. There's someone who had requested we insert page number. I had already closed my laptop when I was sharing. I will insert them today. Page numbering, I will do that today. I saw it when I already had closed my my laptop. So the document was on my phone. Okay, someone has given 615 million Rwandan francs. Is that confirmed? Rwandan francs 615. As a result of this hedge, this trader will realize more. It applies the same way as the forward contract hedge, apart from the other issues, the differences that we cited. I think everything else is the same when it comes to the computation. I want us to wind up this topic with a question, with a past paper question. Open a question in November 2023, question 4. November 2023, question number 4, please. November 2023, question number 4. I want us to finish this topic. We move to another one. We finish. Next week, we finish another one. I will see whether I can get some more time to do more questions. But at least for every paper, we've done a question. November 2023, question number 4. Let us get to that question. If you are there, please. I want to share that question. Okay, let me share. There we are. Check whether you have this question, please. If you can see it on my screen and you have opened it, let me know. Tell me to proceed. Do we proceed? Once you have opened and you can see my screen, tell me to proceed. Tell me to proceed. November 2023, question number 4. November 2023, question number 4. The question is November 2023, question 4. Do we proceed? I'm waiting for your green light to continue. Yes, we can proceed. I see quite a number. Yes. With that agreement, I think I'm allowed to read through the question. Let me read through the question. If you can see it on my screen, or you can see it from your end. November 2023, question number 4. The question title is Casanova Construction Company Triple C. Casanova Construction Company is a Rwandan airport construction company and has been undertaking large airport construction projects around the world. Triple C has just won a tender for the construction of a major airport in the Democratic Republic of Congo, an East African country. According to the contract, the project in DRL will begin in 7 months' time and will take 4 years to be fully completed. Once completed, this airport will serve as a major airport for the country and region. To help DRL ambitious development effort, the East African Development Bank, EADB, has agreed to provide funding to DRL in Languin, Dora. They are calling it in Languin, Dora. Triple C has just completed the construction of a BIF 16 billion airport in Burundi, and its payment is due in 5 months. Triple C intends to use this payment to partly finance its upcoming project in DRL and secure the remaining funds from Rwandan francs loan. Upon receipt of BIF payment, Triple C management has advised that it will temporarily convert into Rwandan francs and invest in the short-term treasury bill, and the funds are needed for the project. The construction contract between Triple C and DRL states that Triple C has shall deposit DAD 360 billion, the contract value in DRL designated bank before the project commences. The contract also obliges DRL to provide an annual return of DAD 170 billion to be deposited at the end of each year until the project is completed. Assume no inflation effect and a discount rate of 12%. Exchange rate available to Triple C, we are given the particular spot exchange rate per Rwandan francs, BIC 19102, that is 1.9102. To that, then we have for DAD currency, 5 months forward, we are given there. We are not given the one for DAD. Currency future contract size 100 million, quotation BIF per Rwandan francs 1, expiring 3 months, expiring 6 months. Then we are given the capital market regulation. We are told that MS Risandro Fernandez, a senior official at the International Monetary Fund, recently made the following comment. Countries have made substantial progress towards implementing capital market regulatory reforms following the global financial crisis, but important gaps remain and new challenges have raised the bar. Therefore, the IMF and country regulators must keep prioritizing their push to make further progress on key aspects of the institution and regulatory framework underpinning capital markets. Required. 1. Compare and contrast forward contract and currency option as approach of hedging a foreign exchange risk. Number B, using appropriate calculation, advise how the 6 months currency risk should be hedged. Note, round your calculation off to the nearest whole number. C, evaluate MS Risandro Fernandez comment on capital market. I want you to read through this question. Just go through it. Just go through it before I can explain it. Please go through it. Please go through it. Go through it 2-3 minutes. You should be done with it. Read through it, read through it, read through it. Good. I believe you have read through the question. I believe you have read through the question very fast. I want to read through it once more so that we can start working on it together. Yeah, I believe you can hear me. I read through the question. We are told that Triple C is a London airport construction company and has been undertaking large airport construction projects around the world. Triple C has just won a tender for the construction of a major airport in the Democratic Republic of Congo, an East African country. According to the contract, the project in DRL will begin in 7 months' time and will take 4 years to be fully completed. Once completed, this airport will serve as a major airport for the country and region. To help DRL's ambitious development effort, the East Asian Development Bank has agreed to provide funding to DRL in Ringwin dollars, that is DAD. Triple C has just completed the construction of a BIF 16 billion airport in Burundi, and its payment is due 5 months. Triple C intends to use this payment to partly finance its upcoming project in DRL and secure the remaining fund from Rwandan France loan. Upon receipt of the BIF payment, Triple C management has advised that it will temporarily convert into Rwandan francs and invest in short-term treasury bill, and the funds are needed for the project. The construction contract between Triple C and DRL state that Triple C shall deposit DAD 360 billion. The contract value in DRL designated bank before the project commences. The contract also obliges DRL to provide an annual return of DAD 170 billion to be deposited at the end of each year until the project is completed. Assume no inflation effect and a discount rate of 12%. Exchange rate available to Triple C. We have the spot for BIF and for DAD. We are also given 5 months forward. Then we are given the currency futures contract size is 100 million Rwandan francs. Quotation is BIF per Rwandan francs. Expiry in 3 months, that will be the exchange rate. If the expiry is in 6 months, that will be the exchange rate. Capital market regulation, we are told that Ms. Elisandro Fernandez, a senior official at the International Monetary Fund, IMF, recently made the following comments. Countries have made substantial progress towards implementing capital market regulatory reform following the global financial crisis, but important gap remains and new challenges have raised the bar. Therefore, the IMF and country regulators must keep prioritizing their push to make further progress on key aspects of the institutional and regulatory framework underpinning capital markets. Required. Compare and contrast forward contract and currency option as approach of hedging a foreign exchange risk. B, using appropriate calculation advise how the 6 months currency risk should be hedged. Round your currency off to the nearest whole number. Evaluate Ms. Risandro Fernandez's comment on the capital market. Let us start with the first one. Compare and contrast forward contract and currency option as approach of hedging foreign exchange. That is something that you should remember from what we learned. I want to summarize it so that we can move fast, but this is something you should remember from our previous lessons. I want to share this one. Let me share my screen so that we can move fast. There we are. There we go. This is strategic. Yeah, I hope you can see my screen. I hope you can see my screen. I want us to read one by one together. I hope that screen is clearly visible. Yes, like that. Good. Oh. Let's look at the criteria: forward contracts, hedge, forward contracts, and currency options. We called it forward contract hedge and the currency options hedge. Number one, the definition. Forward contract hedge is a binding agreement to exchange a fixed amount of currency at a specified rate on some future date. That is exactly what we said. And our options contract is a contract that gives the right, but not an obligation, to buy or sell currency at a specified rate before or at a specific date. In option contract hedge, remember we say that one party has a right while the other one has an obligation. That is just a summarization of the definition. Obligation. For the futures contract, it is binding. Both parties are obliged to transact in forward contract. In currency option, it is only binding to the party with a right and not binding to the party. It is binding to the party with an obligation and not binding to the party with a right. So we call it non-binding. The buyer has the right, but not the obligation to exercise. Simply we say it is binding to the party with an obligation and not binding to the party with a right. Number three, cost. No upfront cost usually unless the forward rate is unfavorable. In forward contract, it's just an agreement. When it comes to the currency option, remember we talked about the premium. There is premium payment to the party with the right, or by the party with the right to the party with an obligation. There is premium payment by the party with a right to the party with an obligation. Note that. Flexibility. Forward contract is less flexible. Fixed rate and fixed date. When it comes to the option, we say that they are more flexible. You can choose whether or not to exercise the option. Remember, the party with the right is so flexible, they can exercise or not. The other point is upside potential. In forward contract, no participation in favorable exchange rate movement. Like in the forward contract, even if the exchange rate in the market is favorable, you cannot participate. In the currency option, it allows participation in favorable movement while protecting against the adverse one. That one we discussed. We said the party with the right will go where they are favored by the exchange rate. The other point is usage. For the forward, it is best for known amount and date of foreign currency transaction. For the option, suitable when future cash flow are uncertain or there is desire for upside. Risk management. Forward provides certainty and full protection from adverse movement. For the option contract hedge, it provides protection but at a cost. The protection to the party with the right and to the party with an obligation, because the party with the right pays the premium. So it allows flexibility. Market availability. For the forward, it is readily available by the banks. For the options, available through banks and currency market, but may be more complex and costly. Those are the features that distinguish the forward contract hedge from the futures contract, from the option contract hedge. We have discussed that. We have said a lot about that. And if you allowed me, I can go to the second part of the question. Let me check whether you people have asked questions so that at least we can move together. Is there any question? Let me see. Did someone say that you are not hearing me? Is it true that you cannot hear me? I can see someone wrote, we are not hearing you. I don't know. Could I be explaining something and I'm not heard? Can you hear me? Someone says at the currency option, it's where put and call option belong. Yes, of course. The put to buy and the put to sell, call is give rights to the buyer. Yeah, someone can say we can hear you. If you cannot hear me, can you check your mic? Can you check your side to find out what the problem could be? I can see people can hear me. So the only clarification someone asked, at the currency option, is it when put and call options belong? Yes, it means a put option gives the seller a right. I want you to write that point somewhere. Put option gives the seller a right and obligation to the buyer. A call option gives, okay, let me repeat that statement. Please don't write. Let me repeat, write this. Put option gives the seller a right and obligation to the buyer. Put option gives the seller a right and obligation to the buyer. Call option gives the buyer a right and obligation to the seller. Always remember that. Call option gives the right to the buyer and obligation to the seller. I hope that one is clear. I can see everyone can hear me. If you cannot hear me, please check your side. The problem could be on your side. Good. Let us continue. I want us to look at the B part of this question. B part of the question. If you have it, you can open. The question says, using appropriate calculation, advise how the 6 months currency risk should be hedged. Now, I want us to do something. Let me share this question so that I can show you how you deal with it in the exam. Remember the questions that we said you always ask yourself, is it a direct quote or an indirect quote? Please, always remember that question. Before you start solving the question, ask yourself, is it a direct quote or an indirect quote? We are told, Casanova Construction Company is a Rwandan airport construction company and has been undertaking large airport construction projects around the world. The company has just won a tender for the construction of a major airport in the Democratic Republic of Congo, an East Asian country. According to the contract, the project in DRL will begin in 7 months' time and will take 4 years to be fully completed. Once completed, this airport will serve as a major airport for the country and region. To help the DRL ambitious development effort, the East African Development Bank, the East Asian Development Bank, has agreed to provide funding to DRL in Ringgit Dora, DAD. Triple C has just completed the construction of BIF 16 billion. Note that point. Triple C is a Rwandan company, has just completed the construction of BIF, BIF is a currency, 16 billion airport in Burundi. The Rwandan company has constructed a deal in Burundi, and its payment is due in 5 months. This company will be paid in 5 months. Triple C intends to use this payment to partner finance its upcoming project in the DRL and secure the remaining funds from Rwandan France loan. Upon receipt of BIF payment, Triple C management has advised that it will temporarily convert into Rwandan francs and invest in the short-term treasury bill, and the funds are needed for the project. The construction contract between Triple C and DRL states that Triple C shall deposit DAD 360 billion, the contract value, in DRL designated bank before the project commences. The contract also obliged DRL to provide an annual return of DAD 170 billion to be deposited at the end of each year until the project is completed. Assume no inflation effect and a discount rate of 12%. Exchange rate available to Triple C, spot rate 5 months forward. Currency future, we are given with a value of 100 million Rwandan francs. Then we are told the expiry in 3 months, expiry in 6 months. Leave that part of the capital market. We go to the question. Compare and contrast. B, using appropriate calculation, advise how the 6 months currency risk should be hedged. How do we hedge the 6 months currency risk? We are given the forward exchange rate. We are also given the currency futures. Let me ask you a question. Is this a direct quote or an indirect quote? Is it a direct quote or an indirect quote? We are given the exchange rate available to Triple C. Triple C is a Rwandese company. And before I ask that question, you should note that over 50% of the information given in this question is irrelevant. The relevant part is the deal between Rwanda and Burundi. All the others are not relevant. The other information is not relevant. What is important is between Rwanda and Burundi. And number 2, exchange rates affecting Rwanda and Burundi. Those are the ones that are relevant for this question. Always note that not every information that is given that is relevant. Look at it and note that much of information is not relevant. So the question is, which is the home country? Which is the foreign country? Which is this a direct or an indirect quote? Is this a direct or an indirect quote? And number 2, which currency is home and which country is foreign? I need someone to help me on that. Is this a direct quote or an indirect quote? I need to see that. Which country is home? Which country is foreign? People are saying, someone is saying, would you kindly make short notes, summary notes on direct and indirect quote? Why do I need to make the short notes and already you have them in the notes? I made them. You have them in the notes. And in fact, short notes with illustrations, they are there in the notes. Everybody is saying it is indirect. And everybody is saying that home country is Rwanda. Rwanda is home currency and Burundi is home currency. Now, what is this? Rwanda is home currency and Burundi is home currency. No, you cannot have it like that. Rwanda is home, Burundi is foreign, the quote is indirect. Yes, at least everyone can understand that. For the one asking, I make notes, please go to, refer to your notes. I've already made very brief notes for that. There's someone who said that this is a direct quote. No, that one I'll disagree with you. It is not a direct quote. We are in Rwanda and the quote is, let me see this other side. Someone says that the voice is low. There's someone who says voice is low. Please, can you adjust your site? It's indirect. Rwanda is home. Home is Rwanda. It is direct. Okay, for those who are saying it is direct, Rwanda is home. If you go back to the question, if you look at this part, exchange rate available, we are given per Rwandan francs, BIF 1.9102 per Rwandan francs. It is the amount of foreign currency per unit of domestic. That is an indirect quote. Refer to the notes. I can open to your notes where I explained and I gave examples for that. So it is indirect quote and home is Rwanda. The other thing we need to notice, what is the transaction size? We are given DAD 360, we are given DAD 170, we are given BIF 16. Which one is the transaction size? Which one is the transaction size to hedge? We are given BIF 16 billion, we are given DAD 360 billion, we are given another DAD 170 billion. Which amount are we hedging? It is good to understand that, because you could understand everything else, but you hedge the wrong thing. Can I see? How much are we hedging? Let me see. Someone, 360, 170, and 16. Which amount are we hedging? Which amount? Someone says 16 billion, another one says 360 billion, 360 DAD, of course, 16 billion. It is always good to note that I'm asking this question because they are the question you should ask yourself in an examination so that you use the correct thing. Oh, there are those who are saying 360, some are saying 16 billion, which are we hedging? Okay, leave it at that. Let me explain. I will explain to you because I know in the exam you will be alone. You will be alone in the exam. So now because I'm with you, I will explain to you. Look at this. We are taught, if you can see my screen, look at this paragraph. We are told that CCC has just completed the construction of BIF 16 billion airport in Burundi, and its payment is due in 5 months. They are receiving the money in 5 months. CCC intended to use this payment to partly finance its upcoming project in DRL and secure the remaining fund from Rwanda from a Rwandan francs loan. Upon receipt of BIF payment, CCC management has advised that it will temporarily convert into Rwandan francs and invest it in short-term treasury bills, and the funds are needed for the project. That is the first statement. The other statement, there is, look at this part, if you can look at what I have highlighted in this paragraph, this part, According to the contract, the project in DLL will begin in 7 months. So there is nothing, there is no money that relates to the project. The issue of the project will come in 7 months' time. So what we are interested in is Rwanda CCC is expecting to receive 16 billion Rwanda BIF in 5 months. They need to hedge. That is what is important. 16 billion will be received. It is amount receivable. It is the one that we need to hedge so that when we receive the money, we will convert it into Rwandan francs. That is the question. And now I will do away with this part. I have explained that part. I believe it is clear. I will share now my Word document so that you can we can work on it together. Let us work on it together. I want us to work on it together. If you can see my screen, there we go. I want us to start with forward contract hedge. Forward contract hedge. From the question, if you have the question, you can go back. We are told that exchange rates, do we have forward contract? We are told that exchange rate, particulars, we are given spot rate per Rwandan francs, and we have 5 months forward. Good. Let me display this thing. I would like you to see it in black and white. I will say, if you can see my screen, please. If you can see my screen, let me know. Transaction size is equal to BIF 16 billion. 16 billion. Forward contract, forward exchange rate, 5 months forward. We are given, how was it? Okay, 5 months forward. Let me make sure that I get you the correct thing because I want you to understand. We have BIF 1.9. Oh, I copied the wrong thing. Let me remove this. We are not even given the forward exchange for the BIF for the DAD. This is how the exchange rate is given. We are told BIF 1.9124, 1.199124, and 9315. Good. So I want us to have it this way. There we go. I want you to tell me, the bank has agreed to give a 5 months forward exchange rate. How much is the amount to realize? I want you to give me how much will the bank exchange the 16 with this. I will not explain that one so that I can see who understand what we have been doing. How much will be realized in this transaction? How much will be realized in this transaction? Please give me the answer. I'm waiting for the answer. It is you to make a decision because we have done this not once, not twice, but many times. Give me the amount that will be realized in 5 months' time. I'm waiting for that figure. Put them in your calculator. I want to see who understands what amount will be realized. I'm waiting. Can I see what you have posted? Someone has posted 83.66 450. 83.66 450. 82, 83, 71, 73. There is 83, there is 82. 83, 82. 83, 65. 83, 65. Let's see. We use the spot in conversion by taking 16 divided by that. Let's see. 83.66. Okay, as exchange. Okay, now let me intervene because there are many. I cannot pick one. I just want to intervene. Remember, I want to make a note here. There's a note. I'm just repeating what I said before. Note. This is a indirect quote. Therefore, the bank will buy the BIF at the higher exchange rate. Amount to realize is equal to 16 billion 16 billion divided by 16 billion we divide by the bank will take the higher so as to pay less. 19,124 19 this 19,315 19,315 per Rwandan francs. This is BIF. The amount that the bank will give you in an indirect quote, they will pay you less so that they can pay more. Can you give me that answer? Share with me that answer, please. Forward exchange rate in 5 months. Can I see that answer? Please share that answer. Can I see that? 82, 83, 717, 82, 80, is it 82, 82 or 82, 83? Some are writing 82, 83, some 82, 82, 82, 83, 82, 83, 717, 717, 718, 717, 318. So can I confirm whether what I'm praising is correct? This will be in Rwandan francs. 82, 83, 717, 318. That is the forward contract hedge. Back to the question, we are told that currency futures contract size is 100 million. So we take 100 million Rwandan francs. The expiry in 3 months, we are given 1.9322. Expiry in 6 months, 1.9367. Now, when it comes to this one, we are buying the futures contract. The question is, how many futures will have to be purchased? That's the question. How many futures will have to be purchased? But now, before even we get to that, we need to ask ourselves, we need to know the maturity in 3 months, in 5 months. But one unique thing about the futures is that it has a defined maturity period. It has a defined maturity period. So the question is, if it has a defined maturity period, how many futures do we need to buy? How many futures are we going to buy? So we need to first ask ourselves, considering that the maturity of the future is 6 months, and here we will receive money in 5 months, we go by the contract. The maturity will be at the end of the period. And our exchange rate is the one that is given in the contract. It is the one that will give us the number of futures to buy. So what is the exchange rate in the futures? It is 1.9367. So 1.9367 is our exchange rate, and it is the one that will help us to determine the number of futures to buy. I want to put it this way: futures contract hedge. Futures contract hedge. The question is, when you get into that futures, you will agree in the contract. If I went back to the question is, let me check the question down there. We are told using appropriate calculation, advise how the 6 months currency risk should be hedged. So we need to determine the amount that will be realized under the future. Amount in Rwandan francs, in the futures expiry date. Now we are given two expiry dates. We are given the first one, it is in 3 months time. If you take the 3 months time, the company CCC will not have received the BIF 16 billion. So they cannot get into contract with that because they will not have the 16 billion. The only time they will have the 16 billion is in 6 months time. So they will receive it in month 5, but wait to convert in month 6 at a predetermined exchange rate. So amount in Rwandan francs is equal to the BIF 16 billion. This one we divide by the BIF for the futures. How much is this? We are told is 1.9367. 1.9367 to Rwandan francs, like that. How much will they realize under the futures contract hedge? Rwandan francs. How much is 16 billion divided by 1.9367? I'm looking for what your response is. I can see Let me see, share your feedback. Here we are. Are we on 8261 706 475? I think that is what I see a majority giving. 8261 475 7060. It says 098 or 706. 706. 706 point. Okay. Let me give it that way. Like that. Like that. Okay. Someone says that if you can use other colors in writing, can be better. The red is not favorable. What is the problem with the red, my friend? What is the problem with red? Someone says that red is not favorable. What is the problem with red? Can someone tell me what is the problem with red? Is there any problem? As someone says red is not favorable, we use another color. Okay, now this is the amount that will be realized. So to get into this contract, to hedge using the futures contract, the triple C should buy or should trade in this divided by 100 million. Should trade in this divide by Rwandan francs 100. So how many units should be dealt with, which is equal to, how much is that? Let me see how much is it, as I see someone who said the red is not good. Red is not clearly visible once one need to make some printout. Oh, you okay. You are saying red is not visible when you are printing. Okay. Now, unfortunately, I've done everything with red. Maybe as we continue, I'll look at it. The only thing I needed the red is because it is visible. If I use blue and black, they will be too close, but I can try another one. I cannot swear. Someone is saying that you cannot see where the 100 is coming from. It is given there. Currency future contract size is Rwandan francs 100 million. 100 million is given there. Did I give 100 billion or 100 million? It is 100 million. And that is what I've given. So how many futures? How many futures, please? How many futures? Let me see. One person is saying 0.0826. Another one is saying 82.6. Another one is saying 82.6. Now, which is which? There's one who is saying is 0 point something. Which is which? 82.6. 82.6. 82.6 contracts. Future, we call them 82.6 futures contract. Then I will say futures are not traded in fractions. Therefore, the trader must trade in 83 futures. 83 futures. So they must be in whole number. You don't trade in fractions. So this trader, to participate, will trade in 83 futures. And that is it. That is how to go about it. I want us to go to the last part of the question. Last part of the question. Let me read back to the question. Unless someone has a question, maybe I can check. If you have a question that must be answered, I want us to finish. Let us finish. There is no, okay. Okay, let's go to the last part of the question. Look at that part, capital market regulation. Capital market regulation. We are told that MS Risandro Fernandez, a senior official at the International Monetary Fund, recently made the following comment. Countries have made substantial progress towards implementing capital market regulatory reform following the global financial crisis. But important gaps remain, and new challenges have raised the bar. Therefore, the International Monetary Fund and country regulatory must keep prioritizing their push to make further progress on key aspects of the institutional and regulatory framework underpinning the capital market. I know that part would have been a problem for someone to answer because there is no direct answer from that part. That is what we call the general thinking and the general argument. Look at my screen. If you can see my screen, defining and purpose of capital markets. She refers to the capital markets. Capital markets are platforms for raising long-term funds through debt or equity securities. This is where you issue equity, and you also sell debt securities. Participants include business enterprise and government. It actually includes the business enterprise, investors, government, regulators. Common instruments include treasury bonds, municipal bonds, corporate bonds and debentures, shares or stocks. To try and understand what is capital market. Role of capital markets in the economy. Number one, capital markets act as engines of economic growth because this is where investors take their money, and the companies looking for capital, they get capital from the capital market. Hence, there is that engineering of the economy. They require regular regulatory updates to function optimally. Capital markets are regulated. We have the Capital Market Authority as the regulator. There are some other countries, they call them capital market commissions. Every country with the capital market, they have a regulator. But now the question was the issue to do with the global crisis. That is after the global crisis. You remember the 2008 global crisis, financial crisis. The other one came in 2020 with COVID. So the reference here is the financial crisis in 2008. Major reforms were introduced to address weakness exposed by the 2008 financial crisis. Reforms targeted over-the-counter derivatives. That is, we have the stock market and over-the-counter, instrument funds, market infrastructure, they were introduced. Then, why do we need to continue monitoring? New developments continue to introduce new risk and vulnerability. Regular assessment is necessary to prevent future financial crises. The importance of oversight by institution. The IMF and national regulator must monitor asset manager, e.g. money market and bond funds, ensure regulation of non-traditional trading venues. Then, importance of ongoing dialogue on financial crisis management. Constructive debates and the consultative are essential to address emerging risks. And in reference to this point, construction debates and consultation are essential to address emerging risks. This week, I am handling clients from the Central Bank of Malawi. Malawi as a country is in financial crisis. In the last 1 month, I have handled issues in Ghana and Malawi because the two countries are in financial turmoil. They are in crisis. When we talk of constructive debates and consultation, it is true. That is what we are doing. We are doing a lot. In the last 2 months, I've done one for the Central Bank of Sierra Leone. I've done for Malawi. That is the one that I'm doing this week. I've done the one for Ghana. This is what you call, it's real, it's reality. That is what we are doing. Constructive debates and consultation. They all send their staff to Nairobi so that we can discuss what has Kenya done to stabilize. What have they not done? They need to do it to stabilize. It is real. What they are saying is importance of the dialogue. Dialogue ensures effective and appropriate regulation of the financial system and the growth of the non-bank financial intermediaries. When it comes to the growth of non-bank financial intermediaries, it is to try and make the money in the circulation to be in the formal banking system. So rapid expansion of firms like insurance, mutual funds, financial exchanges, that is non-deposit taking institution. These require continuous regulatory and attention. What are the emerging issues requiring regulation? Beyond traditional risk, what is facing the world today? Cyber security, fintech innovation, climate change impact. I want to brief you on this one because this is something that I have dealt with and I deal with on my day-to-day assignments. The issue of cyber resilience, the cyber security, from the data I have collected in an assignment I did for the not mobile banking, agency banking of Ghana, I can tell you comfortably that cybersecurity is a big threat. It's a big threat. The fintech innovation, this is still, I did that assignment a month ago for the Central Bank of Ghana, fintech innovation, and my report was in the next 10 years, some countries that are doing so well in agency banking will see a decline in agency banking. Agency banking will not last for long. I got all the data, I have everything. Fintech innovation, because of the fintech. Financial technology will bring down the banking agency because with the advance in technology, people will be able to access their bank on their mobile phones, and they will start doing away with the agency banking. So in like 10 years to come, the issue of agency banking, you don't invest much in agency banking. That one, fintech is going to erode it. The other one is climate change impact. There are so many things that are affecting the climatic condition and which will affect the global world. And these are the issues that are there. Cybersecurity and fintech innovation are there every day. and they are all the measures that we need to do to deal with them. I think that question would have been better answered in any approach that someone would feel fit. I've just given a small overview of what I felt would have helped in that question. You're asking, how do we know which hedging to use? No, but in the exam, the examiner will give you all the details. You are given the information about forward, you are given the information about the future, you are supposed to give him the two. If you are given information about option, like in this case, we didn't have option, we didn't have money market, so we could not have used that. Yeah, so I think that is the question. Where contract size come from in the question? It is given there in the question, and I think I mentioned. I do not understand why question asked. Advise how what 6-month currency risk should be hedged. The hedging is by buying. You see, hedging, futures contract hedge and forward contract hedge. The only part they work different is that futures are standardized. You buy them in units, but forward you can buy any amount. That is the major difference. And actually, that is what we can see here. In forward, we took it the way it is, converted at the exchange rate, 5 months. But when we went to futures, one, we are restricted by 6 months. We can only take it for 6 months. Number two, we can only trade 8 contracts. So that is 83 contracts. We could not do 8.2. So that is the one that this trader had to get into. Okay, we are not given the cost of the future. We are not only given the amount to be realized. And that is what we were interested in. In this question, we are not required to compare, but either way you can compare and see which one realizes more. There is no problem, but we are not required to compare in this question. That is why I didn't say which one is better. We are not given which one is better. But if you are told, you only give the one that is giving you more amount. Allow me to finish. We've taken too long in this topic, but I know the issue to do with international finance. International finance is one wonderful area, and people are still struggling with it. That is why I decided to go through on this one. Let me not continue with it. If we'll come back to it, if we can finish the syllabus in time, we will come back to it. Allow me to introduce the next topic. If we don't do that, you will be on arms telling me that I did not finish the syllabus. I want us to start the new topic. We start the new topic, and I want us to start together. You can see my screen. Let us start the new topic. I want to give you a 10-minute refresher. I want to give you a refresher, 10 minutes, so that we can start a new topic. Please take the 10-minute break, refresher break. Equally be a retro first, so that at least we can finish it by tomorrow. I don't know whether you can hear me. Can you hear me? If you can hear me, we can pick it from there. Yes, I can see people can hear me. Good, good, good. Portfolio theory. Let me ask a question. What is a portfolio? You can see on my screen. So even if I ask, you'll only need to read. A portfolio is a collection of investments in securities or assets with an objective to diversify risk. A portfolio is a collection of various investments such as shares, properties, or projects that an investor holds. The goal of portfolio theory is to provide guidelines for selecting the best combination of asset for portfolio and risk diversification. Risk diversification. When it comes to the portfolio theory or portfolio analysis or whatever we call it, we are looking at a scenario where an investor will make the best investment decision with an objective to maximize on the return and diversify the risk. So what you see here is a key principle of portfolio management is diversification, as I have said, which involves spreading investment across multiple ventures to reduce the risk of losing everything. By diversifying, the negative performance of one investment can be offset by positive performance of another, leading to a more stable overall return. I want to say this, that when it comes to the issue of the portfolio, if today you have 10 million Rwandan francs in your bank account and you wanted to go to the Rwanda Stock Exchange to buy shares, don't go and buy the shares for the best bank in Rwanda only for your entire 10 million. Don't go and buy the best shares for the shares for the best performing telecom company in Rwanda or the best agricultural or entity in the agricultural industry. Buy like 25% in the banking industry, 25% in agricultural industry, 25% in foreign, you invest in forex, 25% you invest in government security. Why do we do that? It is because in case one of the industries go down, all your money will not go down. You will be left with something in the other areas. That is why we say a portfolio is a combination of investment with a return maximization objective and risk diversification. For example, what I have here, an investor with Rwandan francs 100,000 can invest 50,000 each in two companies, A and B. If company A returns 22% and company B returns only 2%, the diversified portfolio yield is 12%. That is, average return is the 22% and the 22%. Let me put it correct. This statement is not correct. Let me give it this way. I'll say 0.5 times 22% plus 0.5 times 2%. So 0.5 times 22 is 11. 0.5 of 2 is 1. You add, you get 12%. This outcome is better than if the investor had put all the money into company B and only earned 2%. That is the reason for risk diversification. You diversify the risk. So investors are generally risk averse, aiming to minimize risk while achieving satisfactory return. A portfolio is preferable to a single investment because it reduces risk without sacrificing potential return, avoiding the danger of putting all your eggs in one basket. The key is to focus on the risk of the portfolio as a whole, not just the individual investment. I think that statement is clear. I want to put another statement here and say there are two factors that determine the efficiency of a portfolio. The efficiency of a portfolio. Number A, number of securities in a portfolio. Number of securities in the portfolio. And B, the relationship between returns of securities in the portfolio. These are two factors that determines the efficiency of a portfolio. Number one is number of securities in the portfolio, and number two, relationship between returns of securities in a portfolio. When you talk of this, we can say that the number of securities, let me explain this part, number of securities in a portfolio. If all your money is in one company and one company collapses, you will lose all your money. If your money is invested in only two companies, you have a 50-50 chance of survival or success if one of the company fails. If all your money is in three companies, you divided it equally in three companies, you have 66% of success if one company fails. Because 1 out of 3, you will be left with the 2 out of 3, 66%. If you invested equally in 4 companies and one company fail, you will have a 75% chance of success in case one company fail. The more company you include in your portfolio, the better, because the risk is more diversified. That is number one, the number of securities in a portfolio. So I can add something and say that the more securities in the portfolio, the lower the risk. The lower the risk. That is the argument about the number of securities. When you make more, you invest some of the money in Rwanda, you invest some of the money in Kenya, some of the money in Uganda, some of the money in DRC. If DRC is unstable, you will have your return in the other countries. If you invested in one industry, banking, telecom, agriculture, mining, if one fail, you are left with the others. Number of securities in a portfolio. The next one is the relationship between the returns of securities in a portfolio. The relationship is defined in two ways. We say that the relationship between returns of the security is defined using Roman 1 covariance and Roman 2 correlation coefficient. Correlation coefficient, we call it R. Correlation coefficient R. Correlation coefficient R. Covariance between returns of securities in the portfolio. The covariance between the returns of securities in the portfolio, we say that this indicates the direction of the relationship, indicates the direction of the relationship, but it doesn't give the strength. The direction of the relationship is either negative correlation, or positive correlation. It is either, it tells you that the relation is negative or the relation is positive, but it doesn't give you the strength of the relationship. It indicates. Now we have the next one is the correlation coefficient R. It indicates the direction is either negative or positive. And the strength of the relation between the returns, in the portfolio, between the returns of securities in the portfolio, That is the correlation coefficient, and I want to elaborate it more here. The correlation coefficient, the correlation and portfolio risk. This relationship, the relationship between the returns of different investments is measured by correlation, which is the key factor in diversification. The coefficient of correlation ranges between -1 and 1. This is important to note. When we say that, I say that they indicate as to whether the correlation is negative or positive. Positive correlation. If one investment performs well or poorly, the other tend to do the same. This offers limited diversification benefit. For instance, shares in umbrella company and in raincoat company will both likely perform in bad weather and poorly in good weather. A coefficient close to 1 indicates high positive correlation. Let me explain that point. What is positive correlation and what is negative correlation? If you want to invest, you are given 3 investments. There is a company dealing with the umbrellas, another one dealing with the raincoats, and another one dealing with what? Another one dealing with the ice cream. Yes, let me say, one is dealing with the ice cream. Umbrella, jacket, and ice cream. Umbrella, jacket, and ice cream. You are given 3 options to choose 2. You go invest half of your money in the umbrella and the other half in jackets. When it is hot, you don't need jacket, you don't need umbrella. That company will not sell jackets and will not sell umbrella when it is hot. When it is cold and rainy, that company will sell jackets and umbrellas. So that decision means that your income is temporary because you will get the return only when it is cold and rainy. If you decided to invest in umbrellas and ice cream, when it is hot, you sell ice cream. You don't sell jackets or umbrellas. When it is cold, nobody who buy ice cream. They buy jackets when it is cold. That means if you are not selling ice cream, you will be selling jackets. That is a good combination. We say that the relationship between the returns of jacket and umbrella is positive and therefore no risk diversification. The relationship between jacket and ice cream is negative because when one is earning, the other one is not earning. That is what it means when it comes to the issues of positive and negative correlation. We say that negative, if one investment perform well, the other one tend to perform poorly. That is ice cream and jacket and vice versa. This is ideal for diversification as the gain in one asset can offset the loss in another. An example would be holding shares in a company that makes umbrella and another one sells ice cream. A coefficient of -1 or close to -1 indicates a high negative correlation. In case of no correlation, the performance of one investment is independent of the other. For example, a mining company and a railway company, a coefficient of 0 indicates no correlation because the two companies are independent of each other. There is nothing that relates. They are completely independent. I want you to ask a question if there is anything that is not very clear so far. Is there any question? Is everything understood? Please let me know. Do you understand that introduction to portfolio? Someone said that for our interest of managing remaining time, we can move quickly where possible. I am managing the time so well. I am working on I have done my budget for the time. Don't worry. Don't worry. Negative correlation is better than positive. It is not that it is better than positive. Negative correlation is the one that diversify risk. Positive does not. Positive does not diversify risk. It is not which one is better. It is negative diversify risk. Positive does not. Any other question? Any other suggestion? Good. Let us go back. We are saying that combining investment with high negative or zero correlation significantly reduce a portfolio overall risk. In theory, perfect negative correlation, a coefficient of -1, could completely eliminate risk. But this is highly unlikely in practice. It may be or may not. Now, I want to do something. I want to give you to demonstrate the covariance. I want to do an illustration. I want you to remove your calculators. Let me demonstrate this illustration because I feel you people need to understand. Anyway, we are not only doing it for the purpose of running, for the purpose of examination, we are doing it because we will apply it in real life. These things are very applicable in reality, please. So, illustration. The following returns relate to two companies. To two companies, Ice Cream PLC, Ice Cream PLC, LC, and Umbrella Limited. Ice Cream PLC and Umbrella Limited. The expected returns under different economic states is as follows, with the respective probability. With the respective probabilities. Economic state, the economic state, probability, then we have ice cream PLC and Umbrella Limited. In case of economic state, I want to use economic state A, probability 0.3. Ice cream will give us 12%, while Umbrella will give us 21%. Economic state B, probability 0.4. Ice cream will give us, let's say 15%. And the Umbrella will give us 18%. Economic state C, this will be 0.3, and this one will be 18%, while the last one will be 15%. Now let's say required, determine the covariance between the returns of the two securities and B, determine the correlation coefficient. Determine the correlation coefficient between the returns of the two securities. I want to explain this. I will give you the formulas and I will explain it well. Look at it. The following returns relate to two companies, Ice Cream PLC and Umbrella Limited. The expected return at a different economic states is as follows with the respective probability. Economic states are ABC, probability 0.343, Ice Cream return and Umbrella return. Determine the covariance between the return of the two securities. Is there anyone with a question so far before I start explaining? Any question? Anything that needs clarification? Okay, if there isn't, can you hear me? Okay, please confirm whether you can hear me or can you see the screen? Can you hear me? So that I know whether we are together. I might be alone in this jungle. Good, 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 good. We are together. We are together. Thank you. Thank you. Let me explain. Determine the covariance. I want to start with the covariance. Covariance. We say that the covariance, we call it cov, the covariance between the two security, the covariance of ice cream and the umbrella is equal to the summation of, I need to insert a summation. Let me insert. Is equal to the summation of, open bracket, open bracket, expected return of one security minus the return of that security multiply by, let me say that expected return of I will use I for the ice cream and I for the ice cream multiply by expected return of umbrella minus the return of the umbrella. So RU is return of the umbrella. Let me make it this way. Expected return like that. Then whatever we get, we multiply by the probability in time period I. And this is what I want to demonstrate. The expected return, this is expected return, I can therefore say that expected return of I is equal to, we have our eyes here, ice cream, 312, 415, and 318. I will say that 0.3 times 12% plus 0.4 times 15% plus 0.3 times 18%. Give me how much it is. Then I'll give you the expected return for umbrella. Expected return for the umbrella. The expected return for I, 0. This one was 21%. This one was 18%. And this one was 15%. This was 0.3013. And this one was 0.3. How much is the first one? How much is the second one? How much is it for the first one and the second one? Someone give 15%. What about the second one? 15%. The second one, if I'm correct, it is 18%. That is the expected return. Now I want to put this probability. I want to put this formula here. This one that I've put here, this one. I'll just put it here. Like that. But I will remove this. I will explain it later. So the first probability is 0. Let me see. Let me go back and possibly pick this. Let me pick this one and press them here instead of typing. I don't need this. The probabilities, like that. Expected return of this one. This one we minus 15%. Put a bracket like that. Like that. Like that. That way. Then I'll pick the next one. I'll open a bracket that way. That way. Then I'll minus 18%. I'll minus 18%. Like that. Then I'll multiply by the probability times 0.3 times 0.4 times 0.3, like that. Can you give me these figures, please? Give me those figures. 15 minus 12 times 21 minus 18 times 0.3. And the second one, the same case. How much is it? First it's 2.7. Someone says it is 2.7. Is it 2.7 positive or negative? You have to be very specific whether it is 2.7 positive or negative. Second is 0. First is 2.7. Second is 0. Is the first 2.7 positive or negative? Negative. Yeah, negative. So yeah, saying the second one is 0. This one is negative. The second one is 0. The third one is? How much is it in the third one? The last one is, oh, someone is asking, why am I taking the return minus expected return? It won't change anything. It won't change anything. It won't change anything. You only need to be consistent. But anyway, I can change it. So see whether it will change anything. See whether it will change anything. 15 minus 18. 18. You see that way. This one I give 18. Sorry. This one I give it 18 minus 21. 18 minus 18. 18 minus 15. 18 minus 15. It won't change anything. So how much is the last one? Is it how much? How much is it? Someone says that the first one was positive 2.7. I don't know how true it is. The third one, someone says it is negative 2.7. Make sure that you get it correct, otherwise. The third one is negative 2.7. So once you've done that, this is what we call the summation, this one. And this is negative 5.4. That is what we call the covariance. If you're told to determine the covariance between the return of two securities, that is the way you go about it. That is the covariance. The correlation, we can say that this indicates a negative correlation, between the returns of the securities, between the returns of the two securities, because the final answer is minus. If it was plus, we would have said it indicates a positive. So this one indicates a negative. Let us go to the correlation coefficient. The correlation coefficient. Correlation coefficient R. We say that correlation coefficient R is equal to the covariance between the return of the two securities divided by let me put it this way, between the returns divided by the risk or the standard deviation. the standard deviation of the two securities. Let me use the standard deviation here. Let me insert the formula for the standard deviation so that it can be okay. Where is the standard deviation? Good, I have it there. The standard deviation. The standard deviation of I times the standard deviation of Abrera. So we divide. So I'll say that this sign here, this one is the standard deviation, is the standard deviation, is the standard deviation, like that. So we need to get the standard deviation of each because we already have the covariance. Let us get the standard deviation for each of the two securities. I want us to determine the standard deviation. Standard deviation. Computing the standard deviation. Allow me to borrow this one so that at least I can avoid a lot of typing. I'm just copying this one so that I can avoid typing. We say that the standard deviation is equal to the summation of, let me insert the summation sign, the summation of expected return I don't want to use I will use the expected return of a security. This one, we square this one, then we multiply by the probability in time period I. You square, then you multiply by probability. I will remove I so that it can read times probability. I will give in each of them, and I will do it this way. I will separate them this way. If you don't want it to disturb you when you are computing, remove the percentage. You take 15 minus 12. I want us to square power to this one. We multiply by 0.3 for the first one. This is multiplied by 0.4. Like that. that way. I can also pick this one and use it here. I want you to compute and give me. Let us start with the first one. Just ignore the negatives. You put 15 minus 12 squared times 0.3. That way it will be okay. I want you to give me the first one. Yeah, there's something. Someone says the standard deviation is on square root. Yes, that is correct. This is variance. I was supposed to put the square root. I was supposed to put the square root. Thank you for that. Thank you for that. But I will use the square root, the one for power. After you've done everything, I will do power a half. Power a half means square root. So don't say that I misread you. It is power a half means square root. Yeah, thank you for that. Thank you for that observation. That was good. Yeah, so let's get the first one, please. Let's get the first one. Let's get the first one. Is someone saying that the second is 0? Give me the values. Give me the values. Let's get the 15 minus 12 squared times 0.3. The second one is 0. Let's go. Let me have it, please. The first one is how much? Someone says that first is 2.7. Is that correct? 2.7. Okay, I'll give it 2.7. What about 2.7? What about the last one? The one at the bottom. First is 2.7. That is the last one is, someone says that is 1.2. Is that correct? The third one is how much? Someone says it is 1.2. Someone says 2.7. 2.7 says it is the same as the first. 2.7. Let us go to the umbrella. Okay, then we sum them up. We sum them up and say this is variance. variance, then we say standard deviation, so this one, the variance here is 5.4. 5.4. Standard deviation, what is the square root of 5.4? Someone says all is the same, 2.7. Do we agree on that? There's someone who has written first is 1.6. For the second security, first is 2.7, 2.7, 2.7. Are we in agreement that both of these two are 2.7? 2.7, 2.7, 5.4. What is the standard deviation? Square root of 5.4, please. Square root of 5.4, standard deviation. 2.32. Another one says 29.16. It's square root, not square. It is square root, 2.323, 2.323. Do we agree that it is 2.323? Confirm. If you agree to be 2.323, just confirm, 2.323. Always try to give the most decimal places, 2.323, 2.323. I will use 2.323. 2.323. 2.323. Correlation coefficient. Correlation coefficient R is equal to, I will use this formula. Remember this formula. I want to take you back to it. I'll press it here. Then I'll say that R is equal to covariance between the return of the two security. We had given it as minus 5.4. Minus 5.4. We divide by 2.323 multiply by 2.323 like that. That way, I will give me the answer for that one. How much is the R? Let me see. What are the people saying? How much is R? Someone is saying that covariance is 0. Where is 0 coming from? Because here I see like we computed the covariance to be, this was our covariance. This one was our covariance. 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 This was our covariance. I don't know where you are getting the 0 from. Unless someone prove otherwise. That is what I have. How much is R? RRR, correlation coefficient. 1.001, 1.0000, all those 00 is because we rounded off. I'm very sure the 2.323 is not exact. If you use the exact, it will give you -1. We say that the R equals -1 means a perfect negative correlation. Hence, if a portfolio is formed, the risk will be 100%, will be fully diversified. The risk will be fully diversified. That is what it means. Unless someone has a question, I have tried to explain that one in the best way. You make sure that you try to go through it, you try to solve it, you see whether you'll be able to get that. We continue with the other part. Let us look at what you call the efficient portfolio. Efficient portfolio. An efficient portfolio provides the highest expected return for a given level of risk or the lowest risk for a given level of return. The efficient frontier is the curve representing all such portfolio. An investor should aim to hold a portfolio on this frontier. Portfolio risk can be divided into two types. Before we get to that, oh my, I need to explain this one. Let me use a graph to explain this one. Let me use a graph, a diagram. I want to explain what is an efficient portfolio, an efficient frontier. We call it an efficient frontier curve. Efficient frontier curve. If you can look at that line, and I have this other line like this. Those two lines, I will have a concave line. We call it a concave line. A concave line. this line, let me give it the best way. This is what we call the efficient frontier curve. It's called an efficient frontier curve. Let me try to join. Good. We say that if a concave line is drawn on a graph of expected returns and risk is measured by standard deviation and this line joins all the securities offering the highest return at a given risk level and the lowest risk at a given returns level. This line is known as the efficient frontier curve. This is what we call the EFC. So if you are told to define an efficient frontier curve, that is the definition, and this is the efficient frontier curve. This line, the one that you've drawn, if on the y-axis we have the expected, this one y is expected return, and on the other end you have the risk is measured by the standard deviation. Oh, what did I do? The risk is measured by standard deviation. The risk is measured by the standard deviation like that. This line is what we are calling the efficient frontier curve. This line is the efficient frontier curve. Efficient frontier curve. the efficient frontier curve, like that. That is the EFC, the efficient frontier curve. That is it. I think I've tried to explain it in the light way. So we continue. Portfolio risk are divided into two. Maybe someone has a question you can ask. If you have a question, please ask. Okay, I don't see any question. Risks are divided into two. There is what we call the diversifiable risks. They are said to be unsystematic risk. These are specific risks of an individual asset or company. It can be eliminated by holding a well-diversified portfolio. The other one is non-diversifiable or the systematic risk, also known as the market risk or the total risk. This risk affects all investment and cannot be eliminated through diversification. It is the inherent risk of entire market. So we have diversifiable, is called unsystematic. We have non-diversifiable, it is called the systematic risk. Those are the two classifications of the risk. The capital asset pricing model is a framework used to determine the expected return on an asset. Its core assumptions include: one, investors are rational and risk averse. The assumption of capital asset pricing model: investors choose portfolio based on expected return and standard deviation, and the market is efficient and perfect. The assumption, the market is efficient and perfect, with all assets being marketable and perfectly divisible. All investors have the same expectation about the asset return. We call it homogeneous expectation, and there is a risk-free asset, and everyone can borrow and lend at this risk-free rate. Then the capital asset pricing model, or CAPM, is said to be a single period model where investor maximizes their wealth at the end of each period. That is what we call the capital asset pricing model. Capital asset pricing model. I don't know whether someone has a question. I know there is a lot that needs to be understood. I'll share the notes so that you can understand. And before I share the notes, before I move to the next item, allow me to first input the page numbers, because someone has asked me that so many times, so that I may not forget. I have put the page numbers now. For someone who asked for them, they are now there. Good. Any question? Let me check whether there is a question. Risk averse means people who try to avoid the risk. Risk averse are people who fear risk. If you are rational, it means you are realistic. You are rational, you are realistic, and you try to avoid the risk. That is what it means. That is what it means. I don't see any other questions, so we can continue. Are there portfolios above the efficient frontier? Yes, you can form portfolios that are above or below the frontier, but we say that they are inefficient. The one on the efficient, they are efficient portfolios. The one below or above, they are said to be inefficient. That's a good question. Okay, so if there is no any other question, let us continue. A systematic and unsystematic risk. A securities total risk can be broken down into two. What you've said, systematic and systematic or specific risk. We don't need to say much about that. Systematic risk like that. Now, when it comes to the issue of the capital asset pricing model, let me check something. Okay. I want to explain the capital asset pricing model. The capital asset pricing model will help us to determine the return. And we say that it's a fundamental formula used in calculating the required rate of return for risky assets. It is based on the idea that investors should be rewarded for the risk they take by receiving a premium on top of the risk-free rate of return. Investors should be rewarded for taking risk. Capital asset pricing model formula, this one, I want you to note it. It is return of a security is equal to risk-free rate plus the beta of equity minus the beta of the security multiplied by the return of the market minus risk-free rate. So RS is the expected return on the capital asset. RF is the risk-free rate of return, e.g. return of the government bond. B is the beta factor, a measure of the asset systematic risk. And RM is the expected return from the market as a whole. We call it expected return of the market. The term return of the market minus RF is the market risk premium, the extra return investor expect for investing in overall market rather than in the risk-free. That is what you get, a compensation that you get for undertaking a risk. The beta factor then adjusts this premium based on how much individual asset return fluctuate in relation to the market. That is just an explanation of that formula. Always remember the formula. Return of a security is risk-free rate plus expected return of the market minus risk-free rate times the beta factor of the security. Any question? Any question? You can post the question. Post the question. Let me see whether there is any question. We use the beta of the security. The beta of the security. Someone is asking, which beta do we use? We use the beta of the security. If you are determining the return of equity, you use the beta of equity. If you are determining the return of debenture, you use the beta of debenture. So it is the beta of the security. Beta of the security that you are determining the return. If you are determining the return of preference share, you use the beta of the preference share. Good. Beta factor. Let us try to understand the beta factor. Beta is a measure of asset volatility compared to the market. We say that it measures how sensitive a security return is to a given risk as compared to the market. If a company's stock has a beta of 2, it means that its returns are expected to vary twice as much as the market. If the market goes up by 3%, this stock is expected to go up by 6%. It will vary twice. The market as a whole has a beta of 1. Always, we say that the beta of the market is 1. It is the benchmark. So a beta of less than 1 indicates the asset is less volatile. It is less sensitive to the systematic risk as compared to the market. A beta of 0 indicates a risk-free asset whose return are not affected by the market fluctuation. It is said to be a risk-free. So beta factor is a measure of how sensitive or volatile a security return is compared to that of the market. The next item we need to look at the capital assets pricing model in action. We say that the capital assets pricing model is a powerful tool for calculating the expected return of an asset based on its systematic risk. Let us look at an illustration. Let me say that this is an illustration. Illustration. Let's look at this. Example, calculating expected return for a high growth stock. Let's say the current market return RM is 12% and the risk-free rate is 4%. A technology company, Innovate Peer Incorporate, has a beta of 1.5, indicating it is more volatile than the market. We'll calculate the expected return of the Innovate under two different market scenarios. Number one, market return increases to 15%. Using CAPM, we can say that the return of this security Innovate is equal to risk-free rate 4% plus the beta factor of 1.5 subjected to 15% minus 4%. That is one argument. The next argument, look at this, market return fall to 8%. We say that in the first one, the return of Innovate Limited will be 20.5. In the second case, we are saying that the return of the security is equal to 4% plus 1.5 multiplied by the 8% expected return of the market minus 4. Its return will be 10%. So look at the two scenarios. When the return of the market is high, the return of the security is high. When the return of the market is low, the return of the security is low. That is just application of the capital asset pricing model in determining the return of a security. I need to see whether someone has a question. Ask a question. This one we will finish tomorrow. We must finish so that we have next week to finish the remaining part. Good. Let's continue. Now we are able to apply the return. As you can see, when the market return changes, Innovate Incorporate expected return changes more dramatically due to its higher beta. Limitations of CAPM. While the capital asset pricing model is an important concept for determining the cost of capital and appropriate discounting rate for project, it does have a few drawbacks in practice. Number one, difficulty in data correction. We say that Accurately calculating an asset beta factor can be challenging because it requires reliable historical data and future market expectation, which may not always be available or precise. Difficulty in data correction is one problem. Number two, idealistic assumption. The model is based on several assumptions that may not be hold true in the real world, such as investor having homogeneous expectation and market being perfectly efficient. These assumptions are questions the model overall validity. And I think you remember the assumptions that we stated, they are not realistic. They are not realistic in nature. Any question? Any question? Is there any question? I want to summarize this idealistic assumption. The model is built on a set of idealistic assumptions that don't fully reflect real world market conditions. What assumptions did we talk about? We listed them up there. Number one, the existence of truly risk-free assets. In reality, all investment carries some level of risk. Someone to tell me which securities are risk-free. Which securities can you say that they are risk-free? Which securities are fully risk-free? Someone says government bonds. Which securities are risk-free? Some people are saying government bonds. For the purpose of the examination, the other one says government treasury bills. Let me ask another question before I respond. Why are government securities, treasury bills, and bonds considered to be risk-free? Why are they risk-free? If I may ask that question, why do you think they are said to be risk-free? Someone to help me understand. Why are the government securities risk-free? Why are government securities considered to be risk-free? Someone. I need to see you understanding. The government can never fail to pay. That is someone who has written that. Because government cannot be insolvency anytime will pay. Because government exist forever and never fail to pay, because investors are assured. Stop there. I can see you all gave it. I want to disagree completely with you, and I want to disagree completely with the theories. I want to disagree. I know that one we can fight the whole night, but I will disagree with you. The assumption that government securities are risk-free, it is a theoretical assumption. It is not real, It is not true. I like what I learned in school and what I have seen in practice. For your information, I have been a corporate consultant for over half of African countries. I have done consultancy in more than 50% of the African governments, multinational entities. I have done corporate consultancy for a number of countries outside Africa. And I can tell you with proven data that government securities are theoretically risk-free. I can only say they have the lowest risk, but they are not risk-free. I will give you a real example. In 2022, after COVID, you can agree with me that in Rwanda, in Kenya, in Uganda, in America, in China, there was some economic crisis. It was the best time to test government's stability. And many countries, they experienced financial crisis. So, the decision that the government made, you will agree with me that there was a problem of inflation, there was a problem of interest rate, and there was a problem of exchange rates. And that one you can agree with me even in Rwanda. The extent to which the countries have so far been able to solve, it depends on how smart the government is. There are countries that are still in crisis. As I said earlier, I am handling an issue for the government of Malawi. They are still in crisis. In 2022, Ghana, one of the best economies in Africa, felt like any other country in financial crisis. When you are in financial crisis, or when a country is in financial crisis, they request for bailout from IMF, World Bank, and the other ADB and other partners. So Ghana in 2022 wrote to IMF and the World Bank. They needed to be bailed out because that economy was collapsing. And to be bailed out means they needed to be forgiven some debts. IMF asked the government of Ghana, to whom did we lend the money? They responded, the government of Ghana. The next question was, to who did the money benefit? The people of Ghana. So IMF and the World Bank lent the money to the government of Ghana for the benefit of the people of Ghana. So the question that was there was, Ghana government want IMF and World Bank to forgive them the debt for the benefit of the people of Ghana. So the other question was, have the people of Ghana lent any money to the government of Ghana? They responded yes, in form of bonds and in form of treasury bills. The condition was, if we are going to forgive you any debt, can you tell the people of Ghana to also forgive you? And that is where the people of Ghana historically came clear that the government would not pay treasury bills and they will never pay the treasury bills and the bonds. They were done what we call the haircut by 25%. If you bought treasury bills worth 1 million, they were told 25% is gone and will never be paid. The amount that is payable was 75%. And that was not guaranteed when? It is when the economy will stabilize. That is the first real case that I can give. Data is still available that you can confirm that the people of Ghana lost money from their own government that they invested, believing that the government will never be insolvent, the government will never pay. The government of Ghana will not pay and is not intending to pay. So when we talk of government securities being risk-free, they are of minimum risk. But for the purpose of examination, just give it risk-free. But know that in reality, when we are dealing with government issues in reality, we face the reality. We don't use the crass theory. The reality is government, and I will say this, government securities are of minimal risk, but they are not risk-free. That is how it is, and that is the truth. Someone is saying that someone can confirm you have always thought that the government security is not risk-free. I hear now it's come nearly to political concern. You are wondering, I don't know what, but that is the truth. I'm giving you the real data, and that is what it is. Government security, from my definition, not for the purpose of exam, they are of minimal risk. They are of minimal risk. Good, that is it, and that is how it is. Please know that when you go to practice, the reality is that the government security are risk-free in theory. Perfect divisibility and marketability of all assets. It is assumed that there is perfect divisibility and marketability of all security. You can try to sell security and you may not. Homogeneous expectation, it assumes that all people have the same expectation. That is not true. It assumes that the returns are normally distributed. That is not true. There is no normal distribution. Okay, the issue of the normal distribution, I have been in a discussion about the return in Marawi. We did data correction, and I can prove with the data that the issue of normal distribution is in books, but not the fact. Single period factor, CAPM assume a single period factor, single period evaluation horizon. That's not true. Empirical testing, it is difficult to empirically test CAPM. You cannot test CAPM like you can go to the lab and come with the results. This is because the model relies on investors' expectation and the true market portfolio, neither of which can be directly observed or measured. As a result, it's hard to definitely prove or disapprove the model. You cannot take it to the lab to test. Single factor model, it assumes a single beta factor. All the beta factors are assumed to be on average. That assumption is not true because in reality, risks are multiple, and this is what we'll be proving under our next heading, what we call the arbitrage pricing theory, or the APT. And with your permission, I can end the class there. Let us deal with the APT tomorrow. Let us deal with the APT tomorrow. CAPM, we are done with CAPM. Let us leave it at that. Unless someone has a specific question, that must be answered now. I think I have finished with the business of today. Thank you so much.